Here's your stock market review for today. We're in earnings season and we're going to get some big players releasing their financial statements this week. At the same time, however, the two things I'm looking at, we've got GDP coming out, and that could be blistering just like it was last quarter. Second, PCE hits on Friday. This is the Fed's favorite inflation indicator, and we'll see what is going on with inflation with that indicator. My take is the same, that we're going to continue to see pressure with inflation, that it's not magically going to come down to 2% and all is well. I expect at the very least bond yields will remain higher for longer, but if GDP comes in scorching, those bond yields could go even higher. Let's jump in. If you're just joining my channel for the first time, thanks so much for stopping by. Make sure to hit the like and follow button. The channel is growing quite rapidly. Thanks so much for all that. Let's jump in. This is the sector tracker. What I do for the stock market review today that I put out every day is I show these are the spider select sectors. And as you can see, this is what happened for today. But what I want to show you is a spreadsheet that I put together over the holiday season. I updated this. It's something that I look at all the time. This is the sectors, but with each of the stocks, I only do one share. I don't do the weighting that the sectors do. And this answers the question for the next 4 quarters, given the current price, what is the individual yield for each stock in each sector, and of course, all S&P 500 and the NASDAQ. And as you can see, there's still a lot of undervalued stocks. Check out the S&P 500 pushing below the 5% level as these prices continue to move higher. Given the forward yield on all 500 stocks, it just dropped below 5%. Still, however, it is above the U.S. 10-year Treasury, which is the benchmark investment rate. XLK, the technology sector, of course, still overvalued, pushing closer to sub 3%. We'll see if some of those tech stocks in the tech sector push below 3%. Moving forward, U.S. Treasury yields kind of went flat for today, just under 4.10%. The thing is, with the U.S. Treasury, this could really move this week. GDP, they're expecting 1.7% for the GDP release coming out this quarter. Okay, we saw a pretty blistering number for the previous quarter. We've also seen 2 retail sales numbers coming in at 0.6 and 0.6% month-over-month growth rate, respectively, for the past 2 months. Very likely, and I believe this is probably what's going to happen, we'll see a pretty hot GDP number. That would send bond yields upward, likely sending stocks downward. But is that necessarily a bad thing? All right, the U.S. 10-year is trading at 4.1. All right, we've been much higher in previous epochs within our economy. Given that, I don't really think that this is too damning of a number, where if bond yields push to 4.25, 4.2, somewhere in that range for the 10-year, I don't think this is really going to sidetrack the economy too much. But at the same time, we're also going to be getting the PCE inflation deflator comes out on Friday. This is my preferred economic piece of data. I look at personal incomes, personal expenditures, and the inflation. The rate of growth of incomes determines the rate of growth of inflation. And we've kind of seen some moderation in income growth, and we've kind of seen some moderation in expenditures, but we're also seeing unemployment move a little bit lower, which means people are coming back onto the payrolls, which means personal incomes will start to move slightly higher. Given that, if that rate of growth starts to climb too much, that could really be problematic for inflation. Those are the numbers that I'm looking at, and I'll keep those numbers posted for you going forward. For today, the stock market review of today, we're kind of moving sideways, and I expect we'll probably continue to move sideways until we get the GDP report as well as the PC inflation deflator next week. We get the Federal Reserve themselves. They could easily backtrack what they said at the latest meeting. I thought it was a bit premature for them to sit there and say, we're penciling in the opportunity for 3 cuts to interest rates next year. That just sounds, you got to be kidding me. Here's the thing. With the economy performing as well as it is right now, if the Federal Reserve lowered interest rates, it would just heat up this economy even further. The economy's a bit too hot right now. And if it starts to inch higher and higher, the Federal Reserve would be in no position to lower rates. They may just keep rates exactly where they are for some period of time. This year, 2024, of course, is an election year. Federal Reserve wants to do nothing that could sway the economy one way or another and potentially impact the presidential election. Because of that, they're going to hold as much as they can that line. At the same time, though, I do not see any information that allows them to lower interest rates given the information we have today. I put out this video on a daily basis, stock market review today. Make sure you look for it, hit that like and follow button. I break down what happened, what to expect in the next couple days with the stock market and the bond market. The bond market, of course, is really driving the stock market, and that's something you got to pay attention to. The huge economic data coming out this week, plus a couple earnings statements. We're in the season. Let's see how that plays out. Make sure to hit that like and follow button. We'll see you in the next video.